Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Bionano Genomics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Bionano Genomics products are used to map genomes. The company's top product is Sapphire. It can be used to analyze the genetic material of cancerous tumors and detect structural variations that can cause many diseases and conditions, including cancers, developmental disorders, and genetic disease. Sapphire allows diseases to be more effectively researched than competing products. Also, it is a lot cheaper than other genomic mapping tools. The company feels its products will be more successful in determining which patients react more severely to viruses. These viruses include COVID. Let's get started with the model. This is a mid-cap company, $3 billion market cap. They're trading at $11 a share, and they have 272 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. Revenue is a sales for the company. It was $10 million in 2017. It's down to $7 million in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. They do have positive gross profit every year. Below that is operating expenses. They have such high operating expenses that they have negative operating income every year. Then below that is the interest they pay in their debt. Then there's other income and expenses. Then below that is pre-tax income. Then their taxes. So the company does have negative net income every year because they're not bringing in much revenue. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses on its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. So the company has negative free cash flow every year. Since the company doesn't generate any cash, they need money from somewhere to run the business. They issued 18 million of stock in 2017, then 19 million, then 21 million, then 33 million. They also issued debt to run the business, 24 million in 2018, 24 million in 2019, and 4.5 million in 2020. They also paid down some debt, but they didn't pay down nearly as much as they issued. The most important part of any business is their operating cash flow. If you cannot generate consistent operating cash flow, you don't have much of a business because you cannot rely on debt and equity financing to run your business in the long term. And the way you calculate operating cash flow, you start with net income, then you have to add back the depreciation of 1.2 million because depreciation is a non-cash item on the income statement. They also pass through 1.9 million of write-offs, 1.5 million of stock-based compensation. They also had a negative 4.2 million in changes in working capital. So their net income is pretty similar to their operating cash flow each year. Let's look at a capital structure. $4 million of equity, $20 million of debt. They're 15% equity, 85% debt. Net debt is debt minus cash, so they can pay off almost all the debt with the cash on their balance sheet. They have a really high WACC because they have a high beta. Their WACC is 25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's 3.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.9 billion. We divide that by 272 million shares. And we get a calculated stock price of $7. They're trading at $11, so they're trading at a 58% premium. It's a sell according to the model. So it's really hard to value a company that has negative free cash flow. The way I estimated their future free cash flow is I looked at analyst estimates. I looked at similar companies, and I also looked through the company's financials. The company IPO'd in 2018, and the stock went down pretty steadily up until a couple months ago. The stock has been increasing exponentially. On December 29th, just 1 month ago, the stock was trading at $1.33. Now the stock price is over $11. And this stock has a really high beta. It's close to 3, so the stock moves 3 times the market. And the stock has gone up 1,000% in the past 52 weeks, much better than the S&P 500. The 52-week low was 25 cents, the high was $13.85. The stock is trading well above its 50-day and 200-day moving average. This is a really liquid stock. About 80 million shares are traded each day for this stock. And of the 272 million shares outstanding, 152 million are on float. Only 6% of the shares are held by institutions, and it has a fairly high short percentage. Almost 11% of the shares on float are shorted. If you invested $10,000 into this company when it IPO'd, you would have lost almost your entire investment if you sold in December. But if you held out for another month, you would have been up to $18,000, which is a really good return on investment. That's an 80% increase in a little over 2 years. Vanguard is the biggest shareholder at 2.5%. The next 4 companies are not well known. Let's look at the financial ratios. The average PE in the market's 11, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 411, so investors are paying $411 for a $1 revenue. Price to book is stock price over book value per share. They're at 831. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $4 million of equity. Their price to book ratio is 831. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They're at 1.1, so they have a good current ratio. Their current assets are $17 million of cash, $6 million of receivables, and $3 million of inventory. So there's a good chance the company will need more debt to run their business over the next 12 months. They had negative $36 million of free cash flow. They only have $2 million of working capital. The best way to look at ratios to compare them to similar companies, the only other company I did in the same industry is Illumina. And Illumina is better in every single ratio. So to summarize, I have them trading at a 58% premium, but like I said, it's really hard to value this company. I rank their free cash flow as 1 out of 10 because they're negative every year. I rank their revenue 1 out of 10 because it's pretty low and it seems to be decreasing. And I rank their ratios 1 out of 10. They do have a good current ratio, but everything else is pretty terrible. Certain industries, like in the medical industry, have so much upfront costs, and it could take them years, sometimes decades, to bring in revenue. But if they're successful and they make a product that's really useful in the medical community, then they could turn into a cash cow where revenue is flowing in and they have tons of free cash flow. It's kind of like an on-off switch. There's nothing going on, it's all negative for a long time, and then it's suddenly gangbusters. One of the issues may be is that you never develop a drug or a product that's useful and the company goes out of business. So when you invest in a company like this, you really hope they're going to develop something important. It's not like investing in a manufacturing company or a restaurant. Revenue comes in pretty quickly. There's some upfront costs, but not nearly as much as a medical company. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.